Household debt is exploding like never before. But what's causing this financial storm to sweep across so many homes? From sky-high living costs to stagnant wages, the reasons behind this surge are more complex and more alarming than you might think. In today's video, we're breaking down the key factors driving this debt crisis and what it means for you and your future. Central banks like the Federal Reserve have been hiking interest rates to curb inflation, but these higher rates have a ripple effect on everyday finances. When interest rates rise, borrowing becomes more expensive. This impacts everything from mortgages to credit card balances, making it costlier for households to manage their debts. As a result, many people might find themselves taking on even more debt just to keep up with payments on their existing loans. This can create a challenging cycle where debt levels continue to grow as families struggle to balance their budgets under the pressure of rising interest costs. Inflation has been driving up the prices of everyday essentials like housing, food, and healthcare. When the cost of living rises faster than wages, it creates a financial squeeze for many families. But how long can households keep up with this struggle? With incomes not keeping pace with the soaring prices, more and more households are relying on credit just to cover their basic needs. Whether it's putting groceries on a credit card or taking out loans to pay for medical bills, this increasing reliance on borrowing is contributing to a steady rise in household debt. The problem is, as people turn to credit to fill the gap between what they earn and what they need to spend, they end up with more debt to manage in the long run. And this can lead to a cycle where it becomes harder to get out of debt because of the cost of living continuing to rise while wages lag behind. As a result, families are finding it tougher to keep up, leading to a growing debt burden that adds financial stress to already stretched budgets. As the cost of living continues to climb, wage growth has struggled to keep up. This growing gap between what people earn and what they need to spend puts a financial strain on many households. To maintain their standard of living, more and more families are turning to debt as a way to cover everyday expenses. When wages don't rise in step with the cost of essentials like housing, food, and utilities, borrowing can feel like the only option. Over time, this reliance on debt to fill the gap leads to an increasing accumulation of what's owed. People may end up borrowing more and more just to get by, but without a corresponding boost in income, this debt can become harder to manage. The cycle is challenging. As living expenses rise but paychecks don't, debt piles up, adding stress to already tight budgets. But can families ever break free from this vicious cycle? The situation makes it difficult for families to achieve financial stability as they are constantly playing catch-up, and the end result is a growing debt burden that weighs heavily on many households, making it tougher to break free and build a secure financial future. The housing market has experienced steep price increases, especially in cities, making it harder for many people to afford a home. To keep up with these rising costs, many families have taken on larger mortgages, which has become a major part of overall household debt. But it's not just the high income prices that are putting pressure on homeowners. Rising property taxes and the increasing costs of maintenance and repairs are adding to the financial strain. As these expenses grow, many homeowners find themselves needing to borrow more money just to keep up with the demands of owning a home. The combination of bigger mortgages and additional costs creates a challenging situation where debt continues to build up. And for many, the dream of homeownership is becoming a financial burden. Student loans have become a major financial challenge for many, especially younger adults. As the cost of higher education continues to climb, students are borrowing more than ever to cover tuition, books, and living expenses. This means that by the time they graduate, many are already saddled with significant debt. For some, these loans can take decades to pay off, creating a long-term financial burden that affects other life decisions like buying a home or saving for retirement. Consumer confidence has remained relatively strong, which has led to an increase in spending. While this can be a positive sign for the economy, much of this spending is being financed through credit cards and personal loans. And the problem is that these forms of credit often come with high interest rates, making it easy for debt to accumulate quickly. Credit cards in particular offer a convenient way to maintain a certain lifestyle, but this convenience comes at a cost. The ease of swiping a card for purchases, combined with the desire to keep up with consumer trends and maintain a certain standard of living, has led to a significant rise in consumer debt. The accessibility of credit, while beneficial in some ways, has contributed to the growth of debt as consumers spend beyond their means. And over time, the high interest rates on these debts can make it challenging to pay them off. Healthcare costs are climbing steadily, and even with insurance, many families face significant out-of-pocket expenses for medical care. These costs can quickly add up, leading many households to take on debt to cover unexpected medical bills, prescriptions, or ongoing treatments. Unfortunately, medical debt has become one of the leading causes of financial strain in the United States, pushing some into bankruptcy. The financial burden of healthcare not only affects the immediate well-being of individuals, but also has long-term consequences, making it harder for families to save for the future and maintain financial stability. Economic uncertainty, driven by factors like geopolitical events, market fluctuations, or fears of a recession, often leads households to take on more debt as a precaution. People may open new lines of credit or take out loans to ensure they have access to funds in case of an emergency. This strategy, while understandable, can lead to increased debt levels, especially if the anticipated economic downturn does not materialize as expected. The uncertainty itself can create a sense of financial insecurity, prompting families to borrow more as a way to build a safety net. However, this approach can backfire, adding to the overall debt burden and making it more challenging to manage finances during tough times. Rising healthcare costs and economic uncertainty are significant contributors to the growing levels of household debt. Government stimulus programs, like those introduced during the COVID-19 pandemic, provided crucial support to many during economic downturns. These programs helped families and businesses stay afloat when incomes were disrupted and economic activity slowed. However, while these measures were necessary, they also contributed to increased borrowing both by governments and individuals. Many households took on more debt, either through loans or credit, to navigate the uncertain times. Now, as the effects of these stimulus programs begin to fade, some families are left facing higher debt levels than before. The temporary relief provided by these programs may have delayed financial challenges for some, but as those supports are withdrawn, the true extent of increased debt burdens is becoming more apparent. Cultural and social pressures also play a significant role in household debt levels. In many societies, there is a strong emphasis on achieving certain milestones, such as home ownership, higher education, and maintaining a particular lifestyle. These expectations can lead individuals and families to make financial decisions that increase their debt. For instance, the desire to own a home might prompt someone to take on a larger mortgage than they can comfortably afford, or the pressure to keep up with peers could lead to financing a new car or other luxury items. The cultural expectation to pursue higher education also contributes to the accumulation of debt. Many people feel pressure to obtain degrees from prestigious institutions, often at a significant financial cost. The result is a growing burden of student loans that can take years, if not decades, to repay. Similarly, the pressure to maintain a certain lifestyle, whether it's owning the latest gadgets, taking frequent vacations, or living in a more expensive neighborhood, can lead to increased use of credit cards and loans. In a society where material success and visible achievements are often equated with personal worth, the drive to keep up can lead to financial overextension. And this can create a cycle of debt where individuals borrow to meet social expectations only to find themselves struggling to manage the repayments. Over time, this can lead to significant financial stress and difficulty in achieving long-term financial goals such as saving for retirement or paying off existing debts. Hey, if you enjoyed watching today's video, do like, share, and subscribe to our channel, and don't forget to hit the bell icon for more